watching Stockwatch. I'm Zinati Guma, and joining me to unpack your stock-related questions today are Shane Watkins from All Weather Capital and Mutooni from Sanlam Investments. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. All right, gents, thank you so much for your time. Really appreciate it. Let's actually start off with Truworths that snuck in a trading statement. I didn't even see it until someone mentioned it about an hour ago. That was yesterday and was a 52-week trading statement. And of course, clearly there was a reason why they snuck it in after market close, because investors were not happy about it. Plunged about, well, some people even say 10%. I didn't even see that. I just saw at the end of the day that they were down 5%. Shane, what had investors bothered about this business update?
So Zanati, Truworths have two businesses. Their South African apparel business and their business in the United Kingdom called Office. The results from Office were actually very good and showed good revenue growth and good profitability growth. The problem is in South Africa, where essentially the core mothership, the South African apparel business, is going backwards, both at a top line and a bottom line level. So I think people have almost existential concerns around the South African business. You know, is it going to be a slow puncture, or can they turn it around? The company itself looks quite cheap. I mean, you've got to say it's trading on sort of about an 8 PE forward, but it's not without risk because, as I said, the earnings in South Africa, which is the main vehicle, are going backwards. But I would also maybe add, the business does have no debt. It's got no debt whatsoever. And so, you know, even though the share looks cheap, they can buy back shares on an earnings enhancing basis. So you've got to weigh up the fact that it's cheap with no debt against the fact that there's no growth in South Africa.
And actually, if I remember correctly, when did TFG also come out with numbers? I think about 2 weeks ago, it was also a similar reaction. Is there just negative sentiment towards the South African retailers at this point in time, Roy?
I think what you're seeing is a reflection of the underlying trends with regards to top line. That the consumer is very subdued despite the falling interest rates. And also remember, the base is going to become more demanding. When you look at last year, pre-election, post-election, things were pretty dire. Then these results have that as the base. So they should actually be quite good. Yes. But I think what it's reflecting is poor consumer sentiment, poor growth in top line, and an inability to manage costs really well. So I think what you see now is people believing that the consumer is not picking up with regards to spending, and expect that to continue over the medium term. So the stocks do look cheap, but because you don't have top line, you don't expect earnings to grow. And remember, they're operationally levered, so they need top line to grow their earnings. So what these companies typically do is they grow top line, margins expand, bottom line grows. If you don't have top line, you have inflation in costs, bottom line goes backwards. So that I think is the feeling around these SA retail stocks.
It's actually such an interesting thing because, I mean, really, at the core of it, we're looking at the state of the consumer. And I actually had an interview with Sim Chabalala, the CEO of Standard Bank, earlier on, and I was asking him about his reading of the state of the consumer, and he actually says that it's a complex. At this point, Shane, would it be a situation of that we're not necessarily negative on the consumer and consumer-facing stocks, but we actually have to be quite picky when you look at these consumer-facing stocks?
So, Nati, I think that's 100% correct. Because if you look at how Pepkor is trading, which is, in fact, my stock pick for tonight, but it's a much lower income retailer selling kind of basic apparel, basic lifestyle goods. They're showing top line growth, you know, into the double digits, sort of 10 to 14% top line growth. Foschini and Truworths are either going backwards or showing very low single-digit top-line growth. So I think it depends where you're positioned in the market. And I think absolutely you have to be discriminating. There are still players in our market that are doing quite well. I think the disappointing thing about the Truworths and the Foschini numbers is that food inflation is very low. It's about 2%. And normally when food inflation is low, consumers have more money to spend on discretionary items such as apparel. And it doesn't appear that that thesis is playing out. And it could be that a lot of money is going into online gaming. I mean, we've seen a lot of reports showing the size of the online gaming market, 40, 50 billion. And I think that is siphoning some money away from other discretionary purchases.
Yeah, and actually seeming that, I mean, one of the, I guess you could say it's a consumer sector is the banking industry, and that's actually done pretty well. It's remained resilient, even though Standard Bank lowered their growth outlook for South Africa for 2025. Roy, how are these banks actually remaining so resilient in this kind of environment?
Well, they're big, diversified financial groups, and they've got many irons in the fire. But the reality is, when you break it down and you look at the exposure to the consumer, so whether it's retail lending, whether that's mortgages, vehicle finance, and all of that, there's really nothing happening there. It's low single digits, flattish, give or take. And you saw that very clearly with Nedbank, whose, I think, investment appeal is actually very SA-centric. So it gives you a very good idea of what's happening here. So again, it goes back to the consumer struggling a little bit. But like Shane says, the conundrum here is that inflation's low, petrol prices have come down, real income growth is coming through, but we're not seeing it come through in discretionary things. What we're seeing it coming through is in some of the cash side of things, which is Pepkor and the like. So maybe gambling is having a bigger impact than comes through in the numbers.
Yeah, all right. Well, let's go.
But when you speak about the bank specifically,
Yes.
I would say what you're seeing is the mix effect. On the consumer side, pretty much nothing happening.
Yeah.
On the corporate lending, a little bit of growth, a little bit of vibrancy there, and then a little bit around Forex and Africa coming through.
Okay. Very, very interesting detail there. Well, as we're sticking to the consumer stocks, there's a question on Boxer. Is Boxer buy at these levels of 67, 68 Rand per share? Shane, I know that you are a pick and pay bull. Is a large part of that because of Boxer or the whole thing?
So, Zanati, I think on the JSE in general, there are a very limited number of stocks that we could call growth shares, where the companies can identify new avenues of growth. And Boxer is one of these companies that I would consider a growth opportunity. I would describe the business as very well managed. I think Marek is an extremely experienced FMCG retailer, and they've got a clear growth path as they expand out of an area where they've been geographically strong, which is the Eastern Cape and KZN, more into Gauteng and the Western Cape. I would characterize Boxer as a share you should buy and hold, and I would guess you would probably earn 10 to 20% per annum from the investment.
Okay.
It's a growth story, and those are limited in South Africa.
Okay. Roy, how would you be reading Boxer and actually the buying, holding, selling?
So I think Boxer has. It was very popular when it came on as a new issue because we all knew it from the pick and pay stable. It has a very consistent business model, very clear market orientation. It's 5,000 SKUs. It's a small box, and their growth rate was supposed to be driven by new outlets coming through. Now, there's a bit of a confusion about the run rate, and I think that's what made them sell off. But like Shane says, they've got a lot of room to run into, to grow into. The market welcomes them wherever they go. It's a fantastic business model. It's a high return model, and it's a growth model. Over the medium term, they will grow higher than average. They will beat GDP for sure. It's just that they're at a high multiple now. So typically, value investors will look at it and say, no, I don't want to look at this. But this is actually one of those few growth shares that exist. Shares that can grow their top line while leveraging bottom line at the same time. Companies like this, We Buy Cars, and that. You'll pay high multiples for them, but over time, you will earn your return.
All right. Well, let's get into the owners of the malls and shopping centers that house these these retail companies, Growth Point and Redefine, which is the better long-term investment, Shane?
Zanotti, Growth Point and Redefine are relatively similar businesses in terms of their portfolio. Growth Point is a bigger company. The market cap is about 50 billion, and the Redefine market cap is about 35 billion. Redefine is slightly cheaper. In other words, it trades on a slightly higher yield, but it also has, I guess, slightly more risk. Both companies have offshore operations, Redefine in Poland and Growth Point in Australia. I guess the major difference between the two is that with Redefine, you're getting a slightly higher yield, but you're taking on slightly more risk.
All right, interesting. Yeah, how would you be reading these two, Roy, and would you be comparing them on any metric?
No, I think the metrics that Shane said are the right ones. The way I think about them is Growth Point's the big gorilla in that market. It's the one that when people want to say they're playing property, they will invest in. But there are a few complexities. They've got a bigger component of office than Redefine, and office has really underperformed. And then over time, their management hasn't been particularly successful at the operating level. They're getting things right now, and I think you've seen a bit of evolution coming through. So from that perspective, from an operator's perspective, I'll take Redefine over Growth Point. But typically, with property stocks, the most important thing is where your view of the long bond yield is, whether it is in South Africa or in the other countries. So on a weighted basis, what you're seeing is long bonds are coming down, which means these companies are becoming more valuable. So this is probably a good time to look at these interest-sensitive stocks, and both of them will move pretty much in the same direction. I don't think, unless you see a big implosion somewhere, they typically will move. If the long bond yield comes down, both of them will go up with a little bit of gearing on one or the other. So I'd say they're both big, they're both liquid, they both give you a solid yield, and they'll give you mid-single-digit growth over the next 2 or 3 years. So I'd say they're both attractive, to be honest.
Okay, all right. Well, gents,
Zanotti, maybe if I can give you a view as a sort of a high-level heuristic of how to think about these shares. As Roy says, they're anchored to the long bond yield.
Yeah.
The reason that they normally trade at a slightly lower yield than the long bond is that you get capital growth in a property stock, where in a bond there's no capital growth. And a good way of thinking about this is, on average, a property share will trade at the long bond yield minus whatever you think, or minus a third of the growth rate that the property share can grow. So let's say the long bond is 10% and you invested in a property share that can grow at, say, 6. A third of 6 is 2. 10 minus 2 is 8. The property share should trade on an 8% yield. Okay. And so that kind of 10 long bond yield minus a third of the growth vector is a good kind of high-level way of thinking about what is the appropriate yield for property shares.
All right. Well, James, we're always talking about buying stocks, holding them, but seldom selling some stocks. And actually, this one viewer points out something very interesting. I find it easier to buy stocks than to sell. Could the panel also have some stock dumps together with stock picks, please? And actually, just with that, I mean, how important is it to make sure that you actually sell things and you sell them at the right time, something that's on the other side of the spectrum than buying, Roy?
So, Nati, let me have a stab at this by saying the following. If you are a value investor, your plan is to buy something that is cheap and sell it when it becomes fully priced. So, the difference between that and growth investing is that the time to sell a growth share is crudely never, because it's a compounder. So value shares are trading opportunities. You buy them at 5, you sell them at 10. Growth opportunities, you buy them at 10 and they compound at 15-20% per annum, and you only sell them when that growth vector declines. So a little bit of the answer to your question is, what is your investment philosophy? Is it value or growth? And what kind of share is it? Maybe if I can take an example out of the retail sector, clearly you're buying Truworths. We spoke about it earlier, trading on an 8 PE very cheaply. But your plan basically is ultimately to sell it when it becomes fully valued. Where if I can contrast that with Boxer, it's a growth opportunity and it will grow for the next 5 or 10 years. And your plan should not be to sell it until that growth vector declines.
That's an interesting dynamics to see it from both a value and growth perspective. Roy, how would you be? How do you actually approach, selling, and when to sell?
So if you're how would I call it? If you're a follower of Charlie Munger, he says his ideal holding period is forever. So he buys stocks and keeps them forever. And the thinking behind that is that stocks aren't little things that you play with. It's an actual interest in an operating company. And if at the beginning you do your work on the stock and on the company, and you're confident that this is going to give you returns above cost of capital, then you'll buy it at the right price and you'll hold it forever. Now that works when you own an insurance company that gives you a lot of float and you have capital that keeps coming in. But for the rest of us mere mortals, we need to recycle capital. So you get into some opportunities, and there comes a time when you see another opportunity that you believe is probably more attractive. Whether you're value or growth, the concept of more attractive and less attractive is very important. So you look at what you have and figure, has this served its purpose? Has it reached the multiple I thought it was going to reach? Has it earned what I thought it's worth? And if it has, then you can cut back a little bit or sell out of the entire position to go into what you think is attractive at this point in time. Clearly, the point here is you have to have an assessment at the beginning of what's valuable to you. You wait until that is achieved, and then at that point, you look around and see, is there any better alternative? And if there is, you get rid of this one or part of it, buy into the other one, and that's how the cycle continues.
Well, as we're talking about Charlie Munger, nice segue into Warren Buffett. Berkshire Hathaway, very interesting question. Berkshire is an investment holding firm, but they don't trade at a discount to NAV. Why is investment holding companies trading at high discounts to NAV, the likes of HCI and Remgro? Shane, I didn't know that. Your take?
Okay. So, interesting question. There can be many reasons why a share trades at a discount to its underlying net asset value, but I guess the most obvious would be, let's say we have a company that has assets of 100, and the required rate of return on those assets is 10% on a risk-adjusted basis. That's what people would expect. But sometimes those assets are only yielding 5%, but you want them to earn 10, but they're only earning 5. So then in that situation, you would trade at a 50% discount because the assets aren't giving you the returns you'd expect. Now, if you look at a business like Rembrandt, which you mentioned, or Remgro, they have had their investment in Mediclinic was underperforming, their investment in Heineken Distel was underperforming. A large number of their core assets were underperforming. And I guess maybe it was delivering a return below that which investors would require for that type of asset. It can also be that investors don't like the combination or mixture of the assets. It can also be that investors don't like the management fee structure, because remember, these assets don't manage themselves. If you take, for example, Renette, which trades at a 50% discount to net asset value, and almost all of the assets are cash. One of the reasons is that the Rupert family extracts a management fee. I think it's about 1% per annum. And if you had to take that management fee into perpetuity and discount it to the present value, you've then got to take whatever the value of that management fee is off of the net asset value. So sometimes the net asset value, if you don't take the management fee into account, is overstated. But I think quite a lot of these assets that you mentioned are actually quite good opportunities. It's more another behavioral factor, I think, that causes the discount to NAV, which is just that these assets are not an easy story to understand, and they've fallen off of investors' radar screens. And it's easy for us to articulate, well, what's the investment case for Pepkor? It's 5,000 stores selling apparel and furniture, easy to understand. These jumbled up assets that end up in holding companies, there just isn't a story. So there's less of a hook to get investors interested. And that's more of a behavioral thing rather than a financial thing.
Well, that's interesting because, I mean, I was just about to say, Roy, because there was a period in which there was so much noise on these investment holding companies and that people just could not be patient with the ever widening discount to NAV, and there was, pressure to unlock value, and we did see quite a lot of corporate action, and so it's been silent now. What's your take on that silence, Roy?
Well, so Remgro decided we will be the capital providers and we'll bring in industry experts to run these businesses. So in Mediclinic, they've got a partner. In Heineken, they've got a partner. And you can see in Massive now, they've got Vodacom. And so it takes time for these things to be realized. But like Shane says, the market always judges you. What is the cost? What is your asset management cost? The cost, the deadweight cost of your head office being in there. What is your return on assets relative to your cost of these assets, and do I have alternatives? Sometimes also you have multiple entry points. Now, if I have multiple entry points, I can arbitrage and figure out I'll enter through the cheapest one. And typically the cheapest one is not the one in the holding structure. So there's many things here. You literally have to be a Warren Buffett who everyone believes and trusts and has a track record of outperformance for it to trade at NAV or around NAV. So yeah, it's a difficult one. Maybe it's a story of these structures are outdated, or maybe it's just that not many people have succeeded at running these conglomerates.
Or something that is not difficult for you, gents, today. Your stock picks. Shane, you've already mentioned Pepkor. Anything to add there?
So, Zanati, I think, as I said, growth is a scarce thing. People will pay higher ratings for companies that have a demonstrated growth path. So everyone will be familiar with Pepkor. They own the Pep brand. That's about 3,000 stores in South Africa and about 1,000 Ackerman stores. They own a business in South America called Avenido. They are growing both their revenue line and their profitability line. And that is impressive to investors in an environment where your economy is only growing maybe, let's call it 2-3%. Well, at the lower end of that. On top of that, as I've said before a few times on this program, show me the incentive and I will show you the behavior. Now, the Chief Executive Officer of Pepkor, Peter Erasmus, personally bought 1.6 billion of shares the other day. And so he's showing his belief in the company. So in some sense, I like the model, I like the management, but if he's prepared to put his money there, then so am I.
Roy, who's showing you the money today?
Astral. So I saw the Rainbow results recently, and they confirmed a few things for me. I think the chicken industry is very cyclical, and at the worst of times, it's horrible, and you've seen how earnings go backwards. Yeah. But we're sitting in the sun right now. IQF prices are rising, volumes are rising, and raw material costs are falling. Astral's got excess capacity, and they've probably been able to sell more chicken through that excess capacity, and their margins must be widening. They're a well-managed business. They no longer have to deal with load shedding or avian flu or any of the negatives that we've seen in the recent past. So I think this year and next year, you should see earnings coming back to all-time highs, and the ability to return capital to investors definitely exists, whether through share buybacks or special dividends. So I think for where it's trading right now, there's quite a bit more upside for that stock.
All right. Well, thank you so much for your analysis today, gents. Really, really appreciate it. You educated us on a lot of things. To our viewers, there are more questions that we didn't get to, but Stockwatch plays every day, and we do have the Stockwatch show live tomorrow at 12:30 p.m. That's in the afternoon. That's it for today's Stockwatch. Thanks to our guest Shane Watkins from All Weather Capital and Roy Mutooni from Sanlam Investments. Up next, the close. Stay watching.